JB Cycles here with another video on May the 4th. So I call this kind of a research video, so I have put on the green color here. I've noticed that a lot of people are bullish and a lot of people are talking about or expecting a new all-time high this year, or the possibility that we could go all the way up to test the all-time highs. So I want to give you my perspective on this. Of course, I do not know the final answer, but here is what I see, or my analysis on this. So, bear market rallies are wild, crazy. After an oversold condition, there's a bunch of buying signals. You get a cascade of buying signals. You are breaking trend lines and moving averages and closing gaps, and all this, it just has to happen. It's the way the market works. At some point it runs out of steam, and that is typically in bear market rallies around the 200-day moving average. That is the natural point where, well, it's very uncommon that we just break through it. Almost always we see selling at around the 200-day moving average. It is possible to break a little bit above and then get the selling, and often we don't get all the way up there, but close to the 200-day moving average, pretty much always we get some selling there. But if that only gives us a dip and a higher low, then on the next attempt we may break over it. But so far this is just a bear market rally, nothing unusual here. But the thing that made a lot of people bullish, I think, here is the recent 3 days. Because we had broken this trend line here, and there's a thing. We have both the non-farm payrolls, we had that on Friday, and we had the Fed meeting next week. And what I've noticed is a very common pattern, at least around the Fed meetings, around a week before every, you get about an upswing. Whatever the market is doing, then, oh, it's a week to the Fed meeting, let's cover our shorts, or it's the bulls, I don't know. But you very often get an upswing into the Fed meeting. And this was technically an very obvious trade. We had a breakout and a back testing, and oh no, non-farm payrolls coming up, Fed meeting, and now we have dropped down to this kind of support level. We have to cover our shorts and wait until the Fed meeting is over. Or the bulls, oh, we have a breakout, I want to get long, please get the dip down to back testing the trend line. We got it, and way up we go. And we even closed above the 50-day moving average. That's a typical resistance or target in these rallies. Very often we do not break above it, but it's not uncommon to break above the 50-day moving average. But now this market has pretty much taken all the cascading buying signals, and now we have to see, is this just a bear market rally or something else? I should also say that there's a cycle supporting this rally, and that is the quarterly cycle and the 6-month cycle. It's the seasonal variation, it's the earnings cycle, and this quarterly cycle is bullish until, well, another week, and then it starts to go sideways, and then finally it goes down again. So we both had non-farm payrolls, we have the Fed meeting, and we have a lot of earnings, and that's normally bullish, and that typically sets up the sell in May and go away condition. So what do I think here? I am using wavelets often in my analysis, and here I have a wavelet that corresponds to the 3.5-year cycle, and the 3.5-year cycle you can also see here in green, and the yellow average here is the 200-day moving average, or the 40-week average. Now, the thing is, we have broken below this average, and this happens after the cycle has topped. That gives us an extremely strong bias that the uptrend is over, and now we are in a downtrend, and our target is the 3.5-year average. We could also break below that one. So there's extremely strong bias that we are now in a downtrend. And you can argue, well, back here in 2018 we had a deep correction also at around a similar point in the cycle, and we recovered and made a new all-time high. Well, this in my what my analysis says is this is different. We didn't break below the moving average, and we had a euphoric blow-off top just before. Here the trend was stronger and we didn't ruin the trend. Here we have a much more stagnation in trend and a much deeper correction and breaking the average. So this is much more bearish. If we go back like here, we see we had a breakdown about the same point in the cycle, and like here about the same point in the cycle. Well, here that was a bit later, but still. After the cycle has topped, if we get the breakdown, then it's a downtrend until we have reached the minimum downside target. But there's a but. Like here in 1965, we did break below the average. But see, that was before the cycle top. In my opinion, this is different. Here we still have momentum from the cycle. That was a false break. You know, if it happens over here, then you can believe the break. But here it's still by the dips. But now here's the big thing. We have 1969. Here we broke down after the cycle had topped, and we almost made a double top. And that is what we should have a look at. So here I'm measuring bull markets, and I'm measuring from the wavelet low. And we see currently we are here in red, and this is a point, well, about a month or two ahead, well, sometime during the summer. That was the point where many of these other bull markets made their highs. But you know, they hadn't, the trend wasn't ruined here. Well, actually here we have 1966. You see, this one topped about the same time as now, and it made a low about the same time as now, and we almost made a double top. So it is possible. We could go break above the 200-day moving average, but I do absolutely not think we can make an all-time high. But we could almost make a double top. That is possible. Two other examples. This is the dot-com bubble top, and this is the financial crisis top. Measuring from the wavelet low, and we see these two, well, topped out about the same time as now, and we're now in a downtrend. So I have another signal. This wavelet has made a top. The thing is with wavelets, when you enter new data, the wavelet can change. It can, if we get a rally, big rally here, the wavelet can say, "Oh, excuse me, I was wrong. The top, I'm topping a bit later." So you cannot trust this signal completely. But I have two scenarios here. Either the green soft landing, and it says we should go down, down, down next month, or the red hard landing, also saying we should go down, down, down. So right here where we are now, it should not last long. We should very soon turn down. Here I'm comparing with 1968. Now the thing is, if we were, you see, we are not, they do not look completely similar. They are not synchronized correctly. But if we were to continue this rally, almost making a double top, I'm very sure that the wavelet will shift, so that when that happens, it will actually look like this. It will shift with some time, and then suddenly it will be synchronized with the 1968 analog. So it is very possible. Another thing I do, I measure the timing of the wavelet low and seeing where is the wavelet high, and I get this distribution. If the previous bear market or cycle has an early low, we will typically get an early top in the next bull market. If you have a late low, we get a late top. And currently this is the situation. Now you could argue maybe it could be a little bit later. Yeah, maybe. So it is possible that we could make